Good morning, good evening, and good afternoon, everybody. This is the Smoking Barrel. I'm Rustin Edwards, based in Geneva, and as always, my compadre in arms, Mr. Matt Stanley, based in Dubai.
Greetings, everyone. No smoking barrel last week because the overall oil barrel was being well and truly smoked in London town. The big smoke.
I think it's like kind of the smoking liver more than anything else.
Yeah,
last week.
the raisin, I think it was called by Friday. No, it was good. It was my first IP week for a while, actually. Obviously COVID, and then last year was a bit meh, but this was the first one that was properly back. You know, born and raised in London, and I went back to London as a tourist. I was taking selfies like me outside Buckingham Palace, and it was quite liberating, but it was good. I mean, I drank some warm brown beer and spoke about, Harry and Meghan. Didn't speak about Harry and Meghan, but, I thought I'd better drop it in the conversation. And then, of course, we spoke a little bit about the oil market. And what better way to summarize it than to smoke that barrel, Edwards?
So what was the overall inference from the different traders in the different pubs during IE week? Because it is IE week, not IP week. IE week now.
Yeah, I refuse to call it IE week. I mean, I know we live in these woke
times.
You
gotta get with the times, Mr. Stanley. Get with the times.
No. We still use petroleum to get around the world, and we still use petroleum to drive. So no, it's IP week. Anyway, enough of my old man belligerence. It was good. I mean, look, it was busy. There was some good parties, and it was very well attended. Shepherd's Market was taken over for a week, as it always is. I would say the overall mood is one of, again, and we use this term again, it's one of a wait and see. I think people have had quite a brutal start to the year compared to last year. I think this year is P&L wise for everyone involved in the whole supply chain, except freight maybe, because we'll touch on that later. But trading to the majors, to refiners, whatever it may be, it's certainly not going to be as buoyant as it was last year. But nonetheless, margins are still there. It's just, overall economic sentiment is fairly weak and has been fairly weak. But when you look at markets, you wouldn't know any difference. And I'm referring to bread. So a lot of people are still like, well, I think bread's going to stay in the 80s. But then the next conversation will be, but we're not seeing that demand that we were hoping for, or we're not seeing the supply issues that we anticipated, or we're not seeing a recession, or interest rates slow down. None of the fears that people priced in to drive flat price up to levels they were have yet to materialize. And I think people were a little bit either under the pump, under pressure, because I'm pretty sure there were some big positions put on, and I can only imagine that they're doing quite poorly based on how differentials have been in the market. Refining margins, ARBs. Are they there as anticipated? I don't think they are. But after 2 pints, the mood picked up, and everyone was back to being bullish again. So yes, carry on.
Well, I mean, if you look at any of the feedback you see from the different traders, trade shops, banks, I mean, nobody has shied away yet from the triple-digit Brent call for the second half of 2023, and it's all based on China, China, China. I mean, that seems to be the glowing refrain from about every analytical front, which to me looks like you have a full market that's aligned on one side of the trade.
Yeah.
Now, as we said last time we had a chat, back on episode 5, there's a rationalization of, you have analytical forefront, you have analytical data, and then you have to have the actuals align with those analytical data points. Otherwise, it's very hard to move the market in the direction that your analysis says it should go. And the data hasn't shown up yet.
Yeah, but if you're a bullish trader, and you've been one once in your time, when I was the other way, I remember we used to have these arguments, and there is always a headline that you can find to go, ha, I told you. So you're the loser now. So let's say, for example, one of our analysts, Homoyun, who's brilliant crude oil analyst, sits in Paris, our Paris office. OPEC oil exports up 600,000 barrels a day in February amidst higher shipments to China, right? So if you're a bull and you're going, yes, I'll grab that. Thank you very much. China demand is there. But then you read past the third paragraph, you'll say, what's actually happening with that crude? Is it being burnt? Is China demand there? Are people flying about as much as they? So yeah, look, it's very much a sort of convenient market for a lot of people right now. If you've got a bullish position on, because how do you read the gas oil storage argument, for example, in Europe? It has been mild. January, February were mild. March, there was a bit of a cold snap in Europe. Gas oil stocks were drawing, but then building again. So I don't know. It's an argument and a market you could form both sides of.
Well, but that's the reason why we have a range bound market. I mean, when you look at crude's basically 81, 86.
Yeah.
It's been that way since January. And it's in that $5 range. Why? Because you've got anticipation of a Chinese demand pull that sometime will come and happen, which I think the Chinese have put a bit of deflation in that bullish bubble by capping their GDP at around 5% as per the People's Congress meeting they had on Sunday.
Yeah.
And then on the counterpoint to that, you've got the US Federal Reserve and the European Central Bank talking about continual interest rate increases and holding interest rates higher for longer to keep inflation under control. And so when you have those two arguments, it does create a bandwidth trade that says, okay, the market really can't go any higher unless you've got a supply disruption or a real genuine increase in demand pull. And the market can't go any lower until you see slowdowns actually being realized due to the fact that interest rates have come off or interest rates are going up. I think one of the big factors that's been keeping energy demand actually in good stead is the fact that natural gas prices in Europe have tumbled so far. Yep. They're now pricing below the price of gas oil when you look at it on an MMBTU basis. And that net impact is actually helping a lot of industry and a lot of companies regain their footings from what happened last year when natural gas prices were going through the roof.
Well, it's down 11% today, natural gas.
Yeah. And you've got a massive contango, and you've got stocks in Europe that are at an all-time high for this time of year.
Yeah. When you talk about monetary policy, do you mean prudent monetary policy in a targeted way? Is that what you mean? Because that's the way the market is looking at it. They're going, okay, is anyone going to second guess what Powell is going to do? I mean, there was an article out at the weekend about, I think from the board member from Atlanta, FOMC member from Atlanta or somewhere, who was saying, we think, okay, it will start easing in terms of the maybe peak interest rates will come in at some point over the summer this year, and the market just grabs it, and it did, and that's why flat price got the boost it got last week.
Well, everybody's still talking pivot. I mean, that's when you look at the interest rate markets, you still have a lot of analysts who are still saying, "Oh, Q4 pivot," because the Fed will have to pivot because the economy is going to slow down so much they have to start lowering interest rates again in order to maintain a certain economic level.
Yeah.
But there's still so much slack in the labor market in the United States. You still have increasing wages. And so the Fed has to do something to control it, because that just rolls into the inflation argument. But nevertheless, I mean, with the cheaper energy price for the baseline industrial energy in Europe, that's going to help keep inflation in check, because that cost structure doesn't have to get passed down the curve, but it's still elevated, and it's probably going to remain elevated.
Well, yeah, but the thing is with the nat gas, I agree with you that that's the main contributor. Of course it is. And a lot of that fear that was priced in last year, probably getting up to this time last year when we hit $140 on Brent. People are still very much of the opinion that we papered over the cracks. That a mild winter, but really between December, January, February was mild. March, like I said earlier, was cold. So there's sufficient material in storage, but will that continue? Will that level of storage continue? What if there is a cold snap, another one coming, and then another one early Q4 next year? I think that people have still got, justifiably so, the concerns that is Europe self-sufficient in gas? And no, it's not.
Well,
And
it's always going to be an import market. But when you look at the curve structure on natural gas,
yeah,
contango on nat gas is a massive contango at this moment.
yeah.
So the financial incentive is there to bring stuff into storage, fill the caverns. So we've
But
gone
you
from
know,
a
you know as
massive
well as I,
backwardation structure to a massive contango structure.
yeah. But you know as well as I do that quickly, as soon as there's a big headline out, that structure just changes within a matter of
Well, it could,
hours, days, if
but
not
the
hours.
fact that Europe is still sitting on 55% stock levels at this time of year, when normally they're in 25% stock levels. So
Yeah.
you don't have that much more to fill up anymore. And so it does push that profile that it would take a massive hit. And what's going to be the massive hit that would drive nat gas stocks to go from the current contango to backwardation? You know, Qatar no longer exports nat gas. The U.S. stops exporting nat gas.
Yeah. No. I think it's an argument that's going to rage on, and one that I'm pretty sure we'll have over the course of the coming year at your favorite podcast, The Smoking Barrel. Stay tuned. But your question about China, I mean, it was, you could tell Monday afternoon, because you know what it's like at these events, IP week. You can tell during IP week that by Monday or late Monday afternoon, people have said the same thing to different people. Hi, how's it going? How was your year last year? Not bad. Yeah. So what's your view on flat price? Yeah, not bad. What about China? You know, people have done their kind of, you write it down on the notepad and just hand it out to people because it's the same rhetoric. And it's great to meet people and see each other again and all that, blah, blah, blah. But the one subject that people didn't really want to talk about or were annoyed by was what it all means, what China demand coming back all means. Because a 5% growth rate in what is arguably now a mature economy, and we've had this argument in the past. I mean, okay, since early 2000s, for 2 decades, they were growing at between 6 and 8% per year, which is a astonishing growth rate to outperform more or less every year and continue doing it for 20 years. A target that they set last year of around 5.5% growth is still a size for, what the world's second biggest economy is what's it, an $18 trillion economy, is a sizable amount of growth. And most people, if you're invested in any kind of fund, a 5% growth, in what is the world's second biggest economy, I'll take that. Thank you very much. Is it the 5%? Is that the reason why Brent is down $1.30? What are we now, 20 to 4 on Monday, the 6th of March? Gas oil cracks are down. Is this all because of China? I don't think the market wants to acknowledge it.
I think that is part of China. I think that is because when you have when the Chinese government is saying, it's not going to be 5%, it's going to be around 5%.
Yeah.
A very ambiguous number at that point. We say around 5%. Is that 4.8? 4.7? Is that
6? Yeah. I'll go that way.
Yeah. It's around 5%. So when you're around a number, it's a bit ambiguous. But I think the other pieces that came in was that there was no stimulus announced, and there were a lot of people waiting on a Chinese stimulus because that was going to drive Q2 demand. And going into Q3 was a stimulus package from the government, so that wasn't announced. And there was also a statement that was made that they would control the real estate market more.
Woohoo! Hello, Evergrande. There you are.
And I'm paraphrasing that, but the fact that they're looking to control the real estate market, which is one of their biggest drivers of growth, tells you that maybe the halcyon days of 2009, when Chinese growth was carrying the world out of the global recession, is not there. Or it may not be there. It may not be there in the size that people are hoping that it's going to be there. And so it does put a bit of caution into the wind now that, well, if China's not going to do stimulus, and China's not going to push for 6% growth, and China's not going to support the real estate market for the overall commodity basket that China buys, how bullish is it?
Well, look, I look at this a different way to balance this argument, because we are a balanced channel and we must balance all things. We're like the BBC. The one thing that I think the market got completely carried away with, bear in mind, it's not even 3 months yet since China announced the easing of lockdowns. It really, what was it, end of December?
From December.
It wasn't December, it was January.
It was December. It was January is when they opened the borders. They eased lockdown in December.
Okay, fine. But when it all came into where you're pricing it into the market, the demand would be there. We're not even in the 3rd month yet, right? We're in the beginning of March still. So I think the market got completely carried away. I agree that a sort of revision downwards of growth for 2023 to 5% from 5.5% is somewhat negative. And I can understand that people what got in on a Monday morning going, especially after IP week, when there was bodies scattered everywhere on Friday afternoon, like a World War II biopic. But it was, in essence, if you're actually looking at it properly, from my turn on a long-term play, regulatory overhaul from China and looking at what the issues may have been before COVID, I think is a positive thing. I think them saying, we are going to be more prudent when it's going to come to monetary policy. We are going to look at the housing sector and know what is potentially a bubble and put some more regulatory framework around it. I see that as a positive.
I don't think it's a bad thing, but it doesn't necessarily drive a growth argument. Because if China was growing because you had buildings being built, cities being built with nobody living in them, as the stories go, and now you've got the government saying, okay, we're going to stop doing that, and we're actually going to build what we need as we need it, versus just build everything and just let's make GDP grow. It does change the demand profile of what the country's actually going to pull. And so the whole thing of putting more controls and more brakes on investment and trying to attract more investment on a more regulated matter does say it's not a hyper bullish story.
I agree. And we've had this chat in the past, maybe a year or two ago, that is this the chance now where the market goes, do you know what? I'm not going to rely on China to constantly be there as the people to pick up, excess US Atlantic Basin crudes or Nigerian West African grades. Oh, I can pick them up a bit cheaper. Do you think the complacency of traders will shift now to going, okay, well, maybe I need to look at other growth areas like West Africa, Latin America, etc.?
Well, I mean, I think that's, people need to start thinking, more broader in scope, definitely. I mean, you just can't be focused on, China as the savior of the world is not probably the most prudent trading strategy to put all your eggs into. You might want to put some of your eggs there, but you might want to diversify yourself around to other markets, like you said, because there are other stories out there that could help change your trade flow and generate more revenue. But I mean, when you look at the biggest chain in the West African market hasn't happened yet, and that's the Dangote refinery. When that puppy gets up and running full case, that's going to be another rearranging of numbers.
Yeah, Q4 we reckon now for Dangote. West, just moving on slightly. It's a nice segue, that Edwards, like that. The Nigerian elections last week. That was a big
worry for a lot of people. It was a big concern.
Well, yeah, it was, but I mean,
but it was a nothing burger.
Huh?
It was a nothing burger at the end of the day when it came to the market. I mean, it caused the market rally on the Friday prior to the elections because there was concern that if there was complete unrest because of the results of the election, you would lose food production out of Nigeria.
Yeah.
Results came in. Yes, the losing parties were ticked off. They didn't win, but
look, democracy won. I think it was a good day for Nigeria. I think there's a few things. We won't dwell on Nigerian politics too much because it's a I've traded that market. I've worked for Nigerian traders in the past. It's something that I really find interesting. But I'm in Cape Town next week. There's a big I am doing my bit for jet fuel demand, by the way, solely myself. So just any distillate traders out there, you're welcome. No, I'm in Cape Town next week for ARDA Week, which is the African Refiners and Distribution Association. And it's packed. The schedule is packed, and it's people are more and more, and I know I mentioned this earlier about looking at different growth areas, and I definitely think West Africa is one. But, for Nigeria last week, Africa's most populous country, flirts between being Africa's biggest economy with South Africa. okay, there are issues. There's economic issues. There's the FX problem. There's fuel subsidies, myriad issues. But look, the UK have got issues. The US have got issues. Australia have got issues. It's not just because it's Nigeria. I mean, they're alone here. They're not at all. I mean, you want to grow somewhere that's dynamic and people are looking to change, you go to one of these West African countries. So it will be an interesting week last week. But I think, just purely from a sort of outsider in, it was successful. I think that the demographic showed up, and Bola Tinubu was the governor of Lagos. He actually lost that state. That went to this other guy, this Peter Obi, I think, who targeted a different electorate. He targeted the middle classes and the younger generation coming through. Is that a shift in Nigerian policy? I don't know. And like I said, we can talk about it for hours. But I thought it was a big step forward last week for the continent in general and Nigeria especially. And it will be interesting to see what happens, what he does. He's got some difficult decisions coming up. So it's going to be a difficult first year, as any presidency is, apart from Donald. He loved it. His first year, he didn't care. It's like gloves off. Have a go. Do what you like. I don't think Bola's quite the personality that Donald Trump is. But, look, what happens with fuel subsidies? No one's going to find that an easy subject to swallow. So, yeah, it was a good week last week for Africa, I think.
Yeah, I mean, and I think when you talk about what's all the other growth story out there in the world, I mean, Africa is probably one of the biggest opportunities in the world to help develop and grow and develop infrastructure, develop
100%.
Energy needs, whatever, because that is probably your next big population base that is looking for things.
1.6 billion people,
yeah,
and investment needed, and middle classes coming through, and it's a geyser of opportunities. Not this geyser. I mean, like one of those ones you get in Iceland. But yeah, it's
we pronounce those as geysers. Geysers.
Sorry, mate. I'm getting my geezers and my geysers mixed up.
Just like it's IE week, not IP week.
Bollocks, no, it's IP week. But yeah, no. So it'd be a good week next week. Obviously, it's more and more, people are looking at the place. But look, just moving on from that slightly, how's all things shipping?
All things shipping, tanker rates still continue to be the dominant player this year so far, as the ton mile story continues to play out, especially when you have the bifurcated fleets of those that are engaged in the Russian trade and those that are engaged in the non-Russian trade. So freight rates continue to outperform.
I've got a question for you on that. Sorry to cut you off.
Oh.
I've got a question for you on that.
Yes.
Just someone could just anything that's shipped under the price cap. Let's say you're shipping. This is all hypothetically. You're shipping a cargo of naphtha, which is cheap, right?
Okay.
Effectively under the price cap. You tell. You've got a certificate of quality that says it's naphtha.
Yep.
It gets a discharge port and it's 92 octane gasoline. Now, because let's say, for example, an unscrupulous person may have the opportunity to say, "Don't worry, bruv, it's naphtha," and then it gets a discharge port and it's gasoline. It's a different product. Is there any enforcement at the discharge port to check the quality of the material?
Well, under the Unified Customs Codes, there are stipulations as to what the specifications need to look like in order to qualify for a customs code.
Right.
Now, a naphtha customs code, gasoline can also qualify because it is a range of specifications.
Right.
Just like you can call diesel a fuel oil because it fits within the definition based on the customs code.
Okay. So this is a potential circumvention.
Well, it could be, but you still have to land it as naphtha into a tank and then change the customs code.
What if it's shipped outside the EU?
Well, number one, Russian product cannot come into the EU. Not allowed.
Right. Yeah, sorry. Yeah, of course. Yeah.
So if it's
God,
shipped into
bless
tanks,
you.
excuse me, pardon me,
Bless you.
if
Yeah,
it's
go
shipped
for it.
in a tank
But
and
you're going to come through the
re
camera then.
reclassify
Sorry, go again.
reclassified as something else, and they can be shipped out again. But because it's still a Russian origin, the origin would have to change because you've reclassified it, you've changed it molecularly into something else.
Okay.
And therefore, then it could go back into the EU as a new product. So it's like the whole thing around refinery transformation. You bring crude oil, you bring in straight run fuel oil into the Star refinery in Turkey. They process it. It now becomes the finished grade out of the Star refinery, and that can all go flowing into Europe without a problem.
Other refineries are available, just in case you've upset anyone.
Well, yes, but that's just an example. But that's an
I know,
example
mate. I'm joking.
that
I'm
it's
joking.
going on.
Yeah, yeah, yeah. Okay.
And there's nothing
Right,
wrong
fine.
with it.
No,
It's
no, no, no. Fine. Yeah, no. It's. I mean, I think it's almost like a segment of the show. Ask Russ about Russian price caps. We need to get something that's got a bit more ring to it. Maybe a little a jingle or something. But no, one of our we got a great freight analyst. I'm dropping names in these analysts today, but Matt Wright, I met him last week. We had a good chat. Went to the Gulf Intelligence lunch. It's very good. But he writes a report today. Russia leapfrogs US to become second highest origin of dirty tanker ton miles. So clearly, the stuff's moving far afield, and this is only a good story for tanker owners.
Well, it's a good story for tanker owners in a lot of ways, but you also have a very low order book, and so you do have this market condition where wet freight, tanker freight, either clean or dirty, can be strong for the next couple of years just because you don't have a strong order book coming in. You've got yards that are occupied building container ships and dry bulk ships and LNG ships. And to get a slot for a tanker, I think it's still late 2026 is when you can lay a keel.
Wow.
So there's a limited pool of ships and a large pool of oil that has to move or needs to move.
And are you attributing the conflict, in Eastern Europe as the only catalyst for why tanker freight has done a 180?
Well, I would say that would have happened regardless, because again, you have an aging fleet with a low order book. And so at some point, those two pieces would come together and cause the market to move higher.
Okay.
Now, I think the bifurcation of the fleet with a dark fleet and a clean fleet has accelerated that process. I think also some of the other new regulations that have come into play are also part of that process as well. The CII ratings, how people are going to trade that. Now you've got the EU ETS that starts up on
The what? The what?
the EU
The what?
ETS or the CII.
Well, both of those. Just
Well,
said
okay,
something.
the carbon intensity index of ships that started off this year, that's going to start playing into how people look at what ships they want to run. If they want to run a less carbon intensive vessel versus a more carbon intensive vessel, that's across all ships, not just tankers. And then you throw on top of that the EU ETS, which is the emissions trading scheme, which is going to start impacting maritime in 2024. And so that incremental cost of carbon starts becoming a factor in your freight economics.
Yeah, of course. No, I mean that's an interesting one because that comes purely down to the fact of all these ESG regulations and carbon footprint and green agendas versus cost, and what wins that argument?
Well, it all eventually rolls into the cost of goods.
Yeah.
So if you're a person in Europe, your cost of goods are going to keep just trickling higher.
Grim.
Fine. Well, and on that bombshell.
Yeah, does that wrap up another series? I just want to say as well, just not a series, another episode. I just want to say as well, everyone who has given us support and reached out and messaged us and had a chat with me last week, pulled me to one side. It's honestly, it means a lot, and we're enjoying it. If a boss is listening, it's not taking up too much time, so don't fret. Things are still being done work-wise. No, but I joke. But it's Russ and I are really enjoying it, and we really appreciate the support. And the more people that subscribe, the bigger it gets, and the more conversation we want to get everyone involved. So a big thanks, and we're only just starting. So yeah, thanks again.
Yep. Thank you very much. So hit that like and subscribe button. Thank you much. And we'll see you all next week.
Ciao, ciao.